Let's talk about what margin is. So, effectively, margin is sold to people as extra buying power, being able to control more money than you have. And essentially, what's happening is your broker or whatever trading platform you're on or wherever you're borrowing from, they lend you money and charge you interest on that money, and they hold your investments as collateral. And if these investments fall far enough, the broker sells them without even asking you. And if the sale of those investments doesn't cover the loan that you owe them, you still owe that balance. So you might have heard recently at the end of July of 2026, the Situational Awareness Fund, which is this AI hedge fund that was run by this 20 something year old. They basically had a $200 million launch in 2024, and they turned that into $40 billion. But then the momentum reversed, and the stocks that they were trading on leverage crashed down. And basically, overnight, the fund evaporated. They were forced to dump all their positions, and they lost it all. A similar thing happened at the same time in South Korea, where millions of leveraged retail accounts hit margin call thresholds and lost everything that they had. And unfortunately for them, within 48 hours of being liquidated, a lot of the stocks that initially crashed already bounced back, but it was too late for them. And that's the lesson in margin. It doesn't make you a better or worse investor. It just compounds the strength of the decision that you're making, right or wrong. If your decision was right, your gains are bigger, sure. But if your decision's wrong and it's wrong enough, or even if it's not wrong on the long-term time scale, but it has a brief dip, your losses get bigger and compounded, and you can be removed from that investment before you ever have the chance to even recover. So let's say you have a cash account with $10,000 deposited in it. Very simple. This is money you already have. You've decided to invest it. There's $10,000 in that account, and you can trade or invest $10,000. Now, let's say you have a margin account where you deposit $10,000, and then your brokerage offers to give you another $10,000 as margin. Now you can hold $20,000 of investments, and whatever compound interest or dividends you earned on that, yeah, they're going to be higher than if you owned $10,000, but only half of that value is actually yours. That other half you still owe to the bank. So the equity that you actually have is the account value minus the loan that you owe. And the key thing to remember is that if the things that you're holding fall down in price, that amount you owe doesn't fall down in price. So if the stock value of whatever you invested in falls from 10,000 to 5,000, the loan aspect is still 10,000. Meanwhile, your equity fell down by 50%. Now let's talk about who profits, because these brokerages, they're not just giving you margin for fun. It's because they make tons of money off of it. And that first aspect is going to be the interest that they earn. Every single dollar that you borrow, there's an interest charge with that. And no matter how your investments do, you owe that brokerage, that bank, you owe them that interest. The other thing is the brokerage sets the terms and they're in charge. They decide the maintenance requirement. They decide how much you need to have liquid in your bank account. They can change all this as they please. And that has no regard for your investment plan or your investment thesis. And it's no or low risk for them. The loan that they're giving you or the margin that they're giving you is already secured by the assets that you already hold. And they can sell those whenever they want if they need to without your permission. And that's the key thing to remember. If you win, they win. If you lose, they still win. So be very, very careful if you're going to use margin at all, and consider, for most cases, not even touching it. Now let's go back to that example. $10,000 are yours, $10,000 are borrowed, and $20,000, the total, is invested. Let's say that investment goes up 20%, and it's now worth $24,000. You still owe $10,000, but now your equity is $14,000. So even though the investment went from $20,000 to $24,000, you turned $10,000 into $14,000, which is a 40% return before interest. And that's the magical part of margin. But now let's look at what happens if the investment goes down 20%. That position is now worth $16,000. You still owe $10,000. But now your equity is $6,000. So even though it was only a 20% loss, for your equity, it's a 40% loss. And then let's look at what happens if the investment falls 50%. The position's worth $10,000 now. You still owe $10,000. And guess what? Your equity is a big fat zero. You're not down 50%. You're done. You're out. If it falls even further than that, the account is worth less than the loan. And now you owe your broker money, even though your entire original investment is gone. So not only did you lose your initial investment, you also owe the bank what you owe them. So with margin, you can lose literally more money than you even have. And this is how lives get destroyed with margin. Now there's initial margin and maintenance margin. Initial margin is how much of a purchase that you have to fund yourself. Typically, brokers will lend up to 50% of the purchase price of an eligible stock. So $10,000 of your cash controls $20,000 of stock. This is on average, but anything that's more risky, it's going to require more of your money to get less margin. Now, maintenance margin is the more interesting thing. That's the minimum share of the account value that must be your own equity. And based on the FINRA regulations, these are usually 25% for long stock positions. Most brokers on average are actually going to require 30 to 40%, and that's going to increase even more depending on how volatile or risky the asset is that you're investing in. So let's talk about how margin call actually happens. So let's say you have that same $20,000 position and $10,000 of it is a loan. And let's say the maintenance requirement is 30%. So if your investment goes down and the account falls to 14,286, your equity is only 4,286, which is 30% of the account. So to illustrate that point, that investment only fell 28.6%. If let's say your brokerage requires a 40% maintenance requirement, if it falls to 16,667 or a 16.7% decline, you're already at that 40% requirement. And guys, this should illustrate to you that you don't even need a crash, even a routine general correction that a normal long-term investor only invested in cash. They might sleep through that. They might not even pay attention to it. Just one of those could completely wipe out your account. And if this happens and now you're below your threshold, really the only options you have is you can deposit cash to make up that gap. You can transfer in eligible securities, sell your positions by your own choice, or repay part of the loan. But there's no warning. That firm, that brokerage, they have the right to sell whatever they want to cover their own ass. And that's one of the biggest drawbacks is the forced selling when you get margin called. Because markets fall all the time. That's normal and it's survivable. And again, for a general long-term investor with cash positions without margin, the thinking is to just ignore that, invest for the long term, and forget about it. But as a margin investor, you don't have that option, especially if your account is falling below those maintenance requirements, because your investments are the collateral for the loan being margin. So you might invest into something when it's at all-time highs with margin, buying into the hype, and then the market falls. Your losses get magnified because you're on margin. You get margin called, everything sells at the bottom, and then, depending on what you were investing in, that market can recover, and it's going to move on without you. So even if you're correct about an investment in the long term, if it has dips along the way, that alone can be enough to wipe you out. So you have to be, again, very careful and understand what you're getting yourself into when you're using margin. And what often gets forgotten is that you're also paying an interest rate on the amount that you're borrowing in margin. So your investments, they need to return at least the interest rate just to break even with what you would have been doing with your own cash without margin. So keep that in mind. You're not getting to borrow this money for free. And remember, guys, the key thing is that you can be right and still lose with margin. Let's say the market falls and you borrow money on margin to invest into it at what you think is the bottom. But let's say it falls even further after you invest into it and you get wiped out. But then it turns around and it goes way up. So technically you were right about the investment in the long term, but because of the timing and because of being early, you still lost. It's not all bad. People who know what they're doing and they have experience, margin can be a useful tool. But these days, especially younger and younger people are targeted to use this stuff and they don't know what they're doing, and it can literally destroy lives. So be very careful with it. So the bottom line with margin, things to remember, it is not free money. You're paying interest and it's a collateralized loan secured by the assets that you're invested into. Whether you gain or lose, everything gets multiplied and compounded, and the effect is exponential. And again, the danger isn't just that your investment might fall and that you're wrong about your investment thesis, but it could be that you just don't have enough for the maintenance requirements and you get wiped out or margin called, and your investment thesis still ends up being right, only you're not part of it anymore. So as with anything else, it depends on your financial situation. This is not financial advice. But in any case, be very careful if you're going to decide to use margin, and in most cases, just avoid it if you don't have the control or understanding of what you're doing. So hopefully that was helpful for you guys. Be sure to check out the description. We're working on a community and some free resources and newsletters. You can find us on any podcast platform as well. Let us know what you want to hear about next, and we'll see you next time. Cheers.